everyone. Welcome to this Economic Times Budget Rising Bharat Summit 2024. We have this conversation series with industry leaders, thought leaders, economists, and policymakers to deliberate on the issues ahead of the Union Budget. This session is on the Indian economy and to take note of what are the opportunities and challenges for the government as it's a crucial budget before the general elections of 2024. So we have with us a stellar panel of Mr. Saugata Bhattacharya, who's a Senior Vice President and Chief Economist with Axis Bank, Mr. Madan Sabnavis, Chief Economist with Bank of Baroda, and Vivek Kumar, Economist with QuantEco Research. Thank you, gentlemen, and thanks for joining us today evening. So I would start with Saugata. Saugata, if you want to set the tone and the context of the budget, or if you like to give any opening remarks, and so with other gentlemen, then we take the discussion forward.
So thank you very much, ET Prime, for this opportunity of interacting with all of you and deliberating on some of the budgets. Let me start very briefly with the macroeconomic context, specifically the global, the external context in which the budget is likely to be made and which India is likely to operate in for the rest of 2023, calendar 2023. So this is one of the rare times in India's history when India has emerged as a pole of global growth. I mean, it probably be the fastest growing economy, large economies in 2023, and is likely to contribute a significant amount to global growth. While on the other hand, I mean, given the expectations of a slowing set of developed markets, which are large export markets, and overall slowing trade, so are one of the main engines of India's growth, which has been trade last year in 2022. That is likely to be more muted. So the growth focus for the current year is likely to shift from external markets on into domestic markets. Equally, because of the rising interest rates globally, and there are early signs of some financial sector distress coming in, I mean, particularly from credit markets. So the financial volatility is likely to remain elevated for the rest of this year, which is where we are going to face capital flows. It is in this context that the budget is will probably have to be made, entailing various trade-offs, which will incentivize the growth drivers in the system, incentivize consumption versus capex, and a whole bunch of trade-offs, balancing which will be the main focus of the budget, given the probabilities that nominal growth in 2023 is likely to be lower than what we have faced before. So on this, let me end my opening statements.
Madan, do you want to give any initial comments?
Yeah, Sunny, because, this budget is being formulated 1 year before the elections. So I think the political economy of budgeting comes into play. Second, I think almost everybody agrees that there's going to be an economic slowdown this year. Now, whether it's going to be 6%, 6.5%, it's definitely going to be lower than 7%. So I think when we are talking in terms of whether the budget is going to go big in terms of reforms to bring about growth, I think that could be a bit over-optimistic, because on one hand, we say on the expenditure side, there are going to be certain compulsions which are required in terms of, as I said, meeting the political economy objectives. And the second part is that since growth is going to be slower, I think there will not be too much, which I would be looking out for in terms of what the budget can do in terms of growth, in terms of investment. So these would be my initial comments.
Vivek?
Thank you, ET Prime, for giving us this opportunity. The global environment is extremely challenging, and we need to see what are the key pressure points on the export sides that the budget addresses, especially for MSME exporters. That is number one. Number two is the switch or the fiscal adjustment between, let's say, subsidies and capex. How does the government or the finance minister is able to maneuver that? We've already seen initial signs of it, wherein the PMGKAY Yojana has now been subsumed under the Food Security Act. So that itself will save about 1 lakh crore to the government in the next year. So these are initial signs of what the government is probably planning to do. Is it going to be matched by eagerness or promptness or much more policy thrust on capex? That is something which needs to be seen. And last but not the least would be what kind of signal that the budget offers to the market participants. So how does the finance minister intend to fund the fiscal deficit? What kind of borrowing plan that the finance minister have? Is there any hint of the union looking to consider listing India into the global bond indices or not in the near future? These are some of the signals that the market participants would also look at very keenly. So these would be the three key takeaways that I would look for in the budget statement.
So as Saugata said, we are going to be the fastest growing economy, but our growth is also moderating. This year, the latest estimates show will moderate to 7% from 8.7% last year. And also the IMF projects that 1/3 of the global economy may be in recession next year. So there are considerable macro risks. Our fiscal deficit remains elevated, current account deficit remains high. So amid these challenges, are there any areas where the finance minister can look to stimulate growth, which is so required?
See, I think that what the budget can do within the limited contours of what would be the overall size of the budget, I say overall size of the budget is important because the kind of buoyancy which we saw in revenue in 22-23 will not be replicated because inflation is coming down, growth is coming down, people will be spending less, probably saving more. And I think the cumulative impact of high inflation in the past will affect consumption at some point of time. So therefore, there will be certain constraints in terms of how your revenue is going to grow. The government will also probably be looking in terms of some kind of movement on the fiscal prudence path, which means they'll have to choose a fiscal deficit ratio, which could be in the region of 5.5% to 6% is what I feel, depending upon what the final number is for 22-23. So in case 6.4 is better to 6, then probably we could go towards 5.5. If it remains at 6.5, we will probably be between 5.75 and 6%. So given this kind of a constraint, fiscal prudence, the kind of limited revenue buoyancy which we're going to get, I think the government will have limited scope in terms of increasing their capex, because I think capex is what we normally associate with investment, which probably leads to a second round investment from the private sector and brings about growth and so on and so forth. As such, I feel that we tend to overstate the importance of government capital expenditure in the overall state of things. So I've always believed that if my overall capital expenditure is 75 to 80 lakh crores in a year, can really 7.5 or 5 lakh crores really drive this big number? We need the private sector investment to come in. So I think harping too much on capital expenditure, while the government will do what it has to do based on the fiscal considerations, I think finally the push for growth has to come from the private sector, which has been lagging in the last 4 years, I would say even before the pandemic set in, because of other issues of consumption, jobs not being created, income not being generated, so on and so forth. So I would be just looking at that in terms of actual expenditure of the government. On the policy front, maybe some further sops being given on the PLI side, but PLI, we should remember, will not entail expenditure for the government until such time that the corporates are able to keep their part of the promise in terms of actually generating that additional output. So covering most sectors under PLI will have a good announcement effect, but that may not actually provide any direct push for growth in the current financial year.
If I might add to Madan's comments, so for one, I think there is a need for India to slow down in a world which is likely to grow at a overall average 2.5% with the developed markets facing prospects of a mild recession. We probably should slow down our own growth as well, because otherwise this will lead to significant macroeconomic imbalances, which makes all policies, monetary policy, fiscal policy, etc., more difficult to manage. So, I mean, we are budgeting a 6% growth. We have, as of this point in time, this is a working hypothesis. The second point is there is a need to slow down the budget spend rate as well, and obviously it will slow down because the nominal growth rate this year for FY23, I mean, of about 14.5–15% will not be sustainable in FY24. They will probably have to deal with somewhere between 11–11.5% nominal growth, and all the revenue and expenditure projections, estimations, etc., will need to be based on that lower nominal growth. So the basic question then is this first major trade-off between fiscal consolidation and keeping the growth drivers, growth momentum relatively intact. Remember again that in an environment where monetary policy is expected to still remain restrictive, tight in FY24, there should not be an undue expansion of the fiscal stimulus. And the government has demonstrated its willingness to make the fiscal response very responsibly, and which is exactly what has saved India the plight of many of the developed markets. So the first point in terms of the fiscal consolidation, and there is a need for fiscal consolidation because interest rates gradually need to start coming down from the high levels. And a fiscal consolidation will allow for a lower market borrowing, which will have an impact on longer term interest rates, which will affect the entire yield curve. So corporate interest rates will also begin to come down. This is very important because credit has been a big driver of growth, particularly MSME growth, and overall cost of funds, given that the short-term rates from monetary policy remain high, the overall fund with the interest rate curve should begin to come down. So fiscal consolidation is important. But together with this, it should not be so tight or so rapid as to actually bring down the growth drivers, because that in turn will create other problems in the system. Finance Minister had announced in her FY21 budget speech of a gradual reduction to 4.5% fiscal deficit levels targets by FY26. And as Madan mentioned, this will probably entail a 50 basis point reduction in the fiscal deficit compared to where we begin with at the end of FY23. So that's the first trade-off that we talk about.
Vivek, I want to take this discussion forward from where Saugata left. I mean, interest rates are going to remain high. From the US Fed also, the one takeaway is that they remain hawkish, even though the yields are easing on their 10-year securities, which means the markets are not perceiving it to be as hawkish as US Fed is conveying it to the market. And in India also, we have seen RBI raising rates and there is no peak yet in sight. So how do you think the whole capex story will play out in this high interest rate regime going forward, even though we are having good credit growth so far this year?
I think that's a pertinent concern because from a market's perspective, while yes, the overall fiscal deficit is something which the markets will focus upon, but there are two things within the headline number that the participants would eagerly look at. One is, how do you fund it? So irrespective of what is the size of the deficit, what exactly do you use to fund it? So typically around 65 to 75% has been the source of funding via the market route. So via the dated security market route, which essentially means that the government issues bonds to fund its fiscal deficit. And this number, if I'm correct, in the current financial year, this number is as high as 4.1 percentage points of GDP. The net market borrowing, close to 11 lakh crore in rupee terms, as a ratio to GDP, it is 4.1 percentage points of GDP. And that's pretty high. That's the second highest in the immediate post-pandemic level. So while, yes, there has been a little bit of let-off, but the borrowing numbers remain extremely high. And that is one of the reasons why the markets are a little bit jittery vis-a-vis what the announcement could be on the funding of fiscal deficit side. That is number one. Now, is this something which is going to have a necessarily negative impact on interest rate? Well, need not be, because there are other enabling factors which could have a salutary impact on interest rates. Number one being on the macroeconomic front, which is the inflation profile that we are anticipating currently, is likely to moderate. So, for example, if you look at what RBI is projecting, they are looking at a 6.7%, 6.8% CPI inflation in FY23 going into the next financial year, while you don't have the full year forecast. But looking at 2 quarters of numbers and looking at where the market participants are projecting, it could very well be in the range of 5.5%. So from a level of 6.7% to 5.5% is the amount of deceleration that could happen on the CPI inflation bit. I think what the markets will be in for a pleasant surprise is on the WPI, although it is not a policy variable, but it would nevertheless help to anchor sentiment. We expect WPI inflation to fall drastically from 9.7 to 2% in FY24. So that's going to be a significant fall. And that comes from our assumption that commodity prices internationally are going to be moderate. The slowdown that everybody is talking about on the global side will not only impact growth, it will also impact price pressures globally. So you will see that manifesting in case of WPI at a much faster pace than in case of CPI. Nevertheless, I guess the overall story is that inflation will moderate as far as consensus view and our own view is concerned. And that should keep a lid on interest rates. So we've typically seen that whenever RBI tends to pause, so our expectation is that with the inflation profile looking more and more comfortable as you move forward, the RBI will probably pause soon after the budget. So post-budget, they have a monetary policy review. We expect 25 basis point rate hike from them. And that probably should be the last rate hike in the current hiking cycle. So if that were to be the case, interest rates do tend to move lower, especially on the government bond side, or government bond yield side. And historical relationship does suggest that over a period of 1 year since the pause, interest rates can come off by 100 to 100 basis points on the long-term bonds. So that could be the capital market side of the story. The deposit rates might still, I would say, can show a bias for hardening, because deposit rates tend to, or in fact, the deposit rates and lending rate, they tend to follow capital market rates with a lag. So there can be a little bit of hardening, which is still left as far as the overall economy is concerned. For the capital markets, the good news is that 1 year down the line or 5 quarters down the line, interest rates probably should be lower than what they are currently. So minus any negative surprises on budget, interest rates should be fairly okay. Is there a scope for a negative surprise given that it is an election year? Well, we don't think that the government will go back on the path of fiscal consolidation, because the finance minister has herself said that we want to target. In fact, I think Saugata also laid out that point very clearly, that they have to reach 4.5 percentage points of GDP in terms of fiscal deficit by FY25. So if FY26, so if you have to be there, you have to take incremental steps, and you would not want any negative shocks to be transmitted via the system at this point in time. So we would expect the consolidation story to continue, whether that is by a magnitude of 40 basis points, 50 or 60 basis points. That depends upon the finance minister's call and the overall intelligent inputs that various ministries to provide. But we would expect extremely low probability of a negative surprise from the budget. By and large, it should be okay. It should be growth oriented, heavily reliant on capex, and a little bit of pruning on the subsidy expenditure. So net, we would not expect any negative surprises. It should be conducive for the capital markets from an interest rate perspective.
You say that post the budget, RBI is expected to pause, or there wouldn't be any negative surprise. But there is also a concern that, despite the recent 10% fall in the dollar index from its recent peak, our INR continues to trade around the same level. I mean, there are also expectations that it may depreciate further. So in that context, where do you see the currency headed? This question is to all the panelists. And what bearing will it have on the budget? Because currency is one big item. It goes in our petroleum imports. It goes in our gold imports. And it's the determining factor to that extent for our fiscal deficit and current account deficit. So whether we are okay on the currency front, or RBI needs to tighten sharper to close the gap.
So currency last year, as in the current financial year, to a large extent was a reflection of what's happening globally. The dollar was pretty strong for a major part of the year. And we as an economy, we were running a high current account deficit. By high, I mean our projected current account deficit for this year is 3.1 percentage points of GDP. It is marginally higher than the long-term sustainable run rate of 2.5%. So we were running a high current account deficit at the time when dollar was strong, and flows were not relatively decent enough to cover that hole. So we ended up or in fact, we probably will end up with a balance of payment deficit for the year as a whole. Our expectation is that we would be close to $38 billion deficit in FY23. Now, going into next financial year, the expectation is that the current account deficit will moderate. One, because international commodity prices have started to moderate. Two, because as Saugata said, that growth impulses globally and domestically are coming off. So that will also start manifesting on your demand side factors. So both on the price side as well as the demand side factors will lead to moderation in current account deficit. Will it be enough for a balance of payment deficit to turn into a surplus? Well, we think probably not, but nevertheless, the balance of payment deficit would reduce drastically next year. So from an estimated level of $38 billion deficit in FY23, we expect it to be closer to $14-15 billion deficit in FY24. So balance of payment deficit traditionally or historically has always coincided with a weaker rupee. And even if, let's say, dollar internationally tends to weaken a little bit, it has already weakened in the last 2 months. Even if it stays flat or shows a minor bias for a lower number, I guess the currency could be on a somewhat weakening turf because of a balance of payment deficit. There can be offsetting impact because your inflation differential vis-a-vis US is going to come down drastically in 2023. We could be in the 5.5% CPI inflation. US also could be close to 5.5% CPI inflation. So practically our inflation differential with US could get eliminated in 2023. That is a recipe for rupee appreciation. But given the balance of payment pressure, although it is mild, we guess, or in fact, we probably believe that rupee can see a very token amount of depreciation, probably in the range of 2 to 2.5% next year. So we would expect it to be closer to 85, 80, and 85.5 before the end of next financial year. So it's just a token depreciation, 2 to 3% magnitude.
Yes. So look at that. I'm not going to hazard a guess on the levels of the rupee, but look at the drivers. So one is the flows, the flows of foreign currency. So one, we expect that the CAD from this year's probable 3.6% deficit will probably moderate to somewhere around 2.6% deficit next year. So I mean, it's more in the range of what RBI defines as sustainable CAD. And this is where, again, the budget also begins to make a difference, because we need to get more foreign capital inflows to finance, to make this lower level of CAD more financeable. As Vivek mentioned, so the balance of payments actually begins to turn slightly positive or be manageably negative. So for this, we need to encourage equity inflows, because bond portfolio inflows probably are not likely to come in, because despite the interest differentials being whatever they are. So we need to make sure that growth does not slow down inconsiderably, so that, because that's a disincentive for portfolio flows, for corporate earnings, etc., for corporate valuations, and that's a disincentive for equity portfolio flows. And more growth opportunities also opens up more opportunities for foreign direct investment flows in this environment. And remember, whatever, so the gap between the Fed funds rate and the RBI's own repo rate will also influence the forward premium for the foreign trade, for the foreign markets. And given the smaller differentials, I think we can expect the forward premium will remain relatively moderate and low. And that's also an incentive foreign capital to come in, because the costs of hedging are much, much lower. So this is the context, again, coming back, in which we are talking about the budget. So that's part of the flows. The next part is the level of the dollar. So again, you are increasingly seeing that the European Central Bank becoming relatively more hawkish relative to the Fed, because they started off much later and they will have to hike rates much more than the Fed. The Fed was probably nearing its terminal rate. So that is an incentive for the dollar also to begin to weaken. If not weaken, it will not likely to, over there. I'm talking over the rest of the year. Is not likely to strengthen anymore. Probably tend to weaken a little bit. That's also a big positive for the rupee. So given all this, the fact that interest rates in India might begin to come down, that the dollar is likely to remain relatively moderately strong or weaken, in fact, and that gives an incentive for the rupee to weaken. That's also an excellent sign. So overall, I think the conditions, global conditions and domestic conditions, are conducive for a slight appreciation of the rupee, both from a flows point of view as well as a currency point of view, the relative state, the currencies between the USD, INR, the dollar index, etc.
Okay, Sunny, I have a different view on this. See, the thing is that when we look at the current account deficit, I think there's a fundamental reason for us to believe it's going to remain in the higher territory. I think it'll remain above 3%. The reason being, today when we say that India is the fastest growing economy, we take a lot of pride in that, which will probably continue in 23, 24 too. This will mean that our demand for imports continues to increase. On the other hand, when you're talking of a recession in the West, our exports are going to slow down, if not decline, which means the current account deficit is going to widen. Even your software receipts, for example, if the West is not going to demand software services from India, there's going to be a problem out there. And if you look at the other economic identity, which we economists use, saying that investment minus savings, that's going to be terribly negative, because look at the situation where financial savings have been falling today. Main reason being because of low interest rates. We need to correct this particular equation. I think the focus has always been in terms of lowering the rates so that people invest. Investment are not taking place, corporates are not investing, but at the same time, savings have gotten affected. I think that's a problem which banks are facing today, saying that my deposits are not increased, my credit is increasing, so where are the funds going to come from? Liquidity shortages at certain points of time. So I think this situation is going to get exacerbated unless there is some correction which takes place in terms of flow of savings. Now, on the capital side, if you look at it, I think FPIs are very, very whimsical. I think it's just a matter of your word against my word that it's going to turn positive in equities. We really never knew. We really never know how it's going to behave. One particular month, they're positive. This month, they're negative. It could be positive again. We have seen FDI already started slowing down. And I think when the West slows down, there'll be fewer amount of investable resources. So that's going to be another issue for us. ECB no longer will be attractive, so it's going up overseas. So therefore, on the whole, I think the balance of payments will be under pressure. So while we will not have the problem which we had last year of the dollar strengthening and weakening of other currencies, but our fundamentals are something which are going to lead towards a depreciation. I think the depreciation could be in the region of around 3 to 5% based on the conditions which we see today.
You spoke about households' financial savings going down. There's another set of data which I looked at. If you look at, say, gold loans or personal loans, excluding a vehicle and home loans, over the past 3-4 years, there's been a massive jump, around 200% for gold loans, around 80% for the other personal loans, compared to when you look at non-food credit growth of around 30%. So could it be the case that this rising household debt levels are also a signal of distress, that they are borrowing more because the incomes have not risen as much, and inflation has sort of eaten into their savings, and they have to resort to more debt? And what does it mean for the economy in general?
No, I think, Sunny, you have answered all the questions out here, because what you're saying is exactly what's happening. When we say consumption has gone up, pent-up demand, so everybody has been consuming, I've not been saving. My incomes are not going up, jobs are not being created in adequate numbers. So today, look at it, most of the people in the organized sector, layoffs taking place. Startups have flopped almost across the board. So in this kind of a situation, the very fact that we see people going and taking more consumer loans, it's good for the banking system. I work in a bank, I'm very happy about it. You take loans against gold, it's a good sign people are borrowing money. But the fact that you're pledging gold means you're actually in a desperate situation. You don't want to give up consumption. Consumption levels have gone up because inflation has been very high. And I think one thing which people miss is when we say inflation is coming down, let's realize that prices are not coming down. 6% or 5% means I'm still paying 5% more. It's actually hardly a comfort. As economists, we can all say that number coming down, monetary policy targeting is the inflation rate, so therefore we bring down rates. But the fact is, cumulatively in the last 3 years, inflation has gone up by 20%. Has your income gone up by 20%? The answer is no. So I think that's the problem which we are having.
Saugata, you want to throw some light on this rising household debt? I mean, I haven't looked at the household debt to GDP data, but I think still it will be rising, even though we'll be below other emerging markets. It's 37% for us.
Absolutely. So actually, it's not. The RBI data that I've seen,
Okay.
given household assets and liabilities,
Okay.
so household liabilities have not gone up. Household liabilities are the loans that the households take. Yes, there has been growth in credit to a very large extent has been driven by retail and retail home loans, personal loans, etc. The gold loans, etc. are a very small component of the total the personal loans, the retail loans that banks give. So while there is an element of distress, of stress, if not distress, stress on household incomes and the desire to keep consumption levels high, so borrowing, but I do understand that some part of this is being used as an alternative means to finance, say, housing construction, retail residential construction, yeah, loans against shares, personal loans, etc. Some part has been used till now to finance exposure to equity markets. Yeah, so which is another reason why you are seeing that retail investments via mutual funds, via direct stock holdings has increased. Those are likely to come down because I mean equity markets will probably not go on all that much. But overall, household debt, overall the aggregate household liabilities and debt remains relatively okay. In fact, which is the really remarkable thing that you have seen, that despite the very rapid 215 basis point increase in the RBI repo rate and actual market rates, short-term rates have gone up even more, much more than the increase in repo rates, there's hardly any sign of stress in either the retail portfolios or in the MSME portfolio, the micro and small. Of course, there will be some slippages that which will inevitably happen. But the resilience of these segments seems to suggest that till now, cash flows have been relatively okay. So given all of this, the overall level of household debt, the amount of stress that we are seeing in the system, the potential of cash flows still being relatively okay. Yes, I mean, given the pace of interest rates hike, there will be some problem, but I hope that remains on the margin. The overall bulk of the bank and NBFC books, exposure to the micro, small, and retail segments still remains relatively sound, which is actually what the RBI's financial stability report also suggests.
So I want to connect this point to some other data sets. We have seen in the recent quarter GDP data that the private consumption is growing reasonably well. But if you look at the manufacturing sector, the full year growth is projected at around a little over 1%. And in the prior quarter, we have seen a contraction. So how do you see this anomaly? Does this mean that we are importing a lot and manufacturing is not picking up? And can the budget address this anomaly?
See, Sunny, if I have to take on this question, I think I'd like to hear what Vivek and Saugata also have to say. See, look at the way in which GDP for manufacturing is calculated. See, it's based on the value added, which is based again on the P&L accounts of corporates for the organized sector and IIP for the unorganized sector. Approximately 75-25 is the ratio. Now, what we have seen is that in the first half of the year, which I suppose the NSO has extrapolated for the full year, profits have actually come down. They have fallen. So if I look at the non-financial sector, there has been a fall in terms of your profits, which means value added, which is profits plus salaries and wages, has declined. So I think that's the reason why we're seeing that the manufacturing sector has fared not so well, growing by just around 1.5% or so. Whereas we're looking at consumption, I think the reflection is really coming in terms of our GST collections, which have been very robust because of, I would say, inflation, as well as the fact that there has been this pent-up demand situation, which has led to higher consumption. So I don't see any kind of anomaly here. And a large part of this consumption which you're talking of would also be in services, which were just opened up in the year 22-23. So I think there was this penchant for traveling more, eating more, doing all kinds of things regarding the services. So I think that's why we have seen this kind of an uptick. So I don't see any contradiction out here as such, but definitely this can be attached to the earlier issue we were discussing in terms of savings coming down because consumption went down.
So manufacturing is actually coming down. I mean, the growth rate of manufacturing is actually lower, has moderated. And is this likely to be a problem going forward? There might be some reasons to suspect One, because overall exports are likely to slow down. I mean, so exports of vehicles, of consumer durables, electronics, etc., is likely to slow. So that's one. I don't know to what extent domestic consumption will offset that particular slowdown on the external front. But my own sense is, if the capex momentum remains good, if the pipeline, and increasingly you are seeing more and more of private sector capex, if that pipeline remains robust, then there is every reason to believe that the infrastructure intermediates like cement, steel, etc., and down the line from the subcontracting segment, commercial vehicles, tippers, dumpers, etc., electronics, and the other, the defense, aerospace equipment, so all of that is likely to slowly keep boosting consumption. One of the things that we have seen is that the sectors which have actually received PLI money, so those segments have been doing well. And increasingly, given the spread of capex across segments, typically they used to be concentrated in a few segments. We are beginning to see signs that private sector capex is beginning to spread across sectors, across segments, specialty steel, mid segment steel companies, etc. So if all of this happens, then the flow of orders will begin to flow down the supply chain onto MSMEs, and that's the segment which actually consumes more, and that is what should drive manufacturing going ahead.
I mean, we had few years back, we had the largest cuts in terms of corporate tax rate cut, which was supposed to spur investment and private capex. Obviously, post that we had the COVID, which sort of killed the momentum. But still, there is a view that private capex has not picked up as much as one would have expected. And there is another kind of that you addressed one side of the issue, but you didn't address the demand side. So the demand didn't come back for the factories to come up, for the investment to happen. So should there be something, say, on the personal income taxation side, any moderation cuts required for this loop to complete and for that virtuous investment cycle to kickstart?
I would say that, one of the reasons why cutting corporate tax rates hasn't worked is that our capacity utilization rates still remain. We have the RBI data, but that's based on a very small sample of companies. And if you see where is investment taking place, if you look at the CMI data, which came out recently, it's more in the infrastructure-oriented industries. So what you're saying is, right, consumption has not increased. And you see, consumption increases only when income increases. Income increases when you create jobs. So the problem you've had is when job creation has not been at a rapid pace. So there can be a lot of debate about whether jobs are created, EPFO data, CMI data. But at the end of the day, if jobs are really created, people will spend money. So I think that's one of the reasons why there has been this lacunae in demand, and that's why investment has been slowing down. That has to be reversed. So now cutting corporate income tax rates will help, but you have to do it substantially. If you're going to do it in a meek manner, keeping the fiscal numbers in mind, then I don't think it will be substantial. It won't really move the needle.
Building on Madan's point, I have a slightly different angle to this, because what is happening now is that India is beginning to do very well on the design space. You've already heard of the data centers. A lot of MNCs are coming in and setting up actual design-oriented segments. They are hiring people from the mid-tier colleges, engineering schools, not the top-level colleges, etc., from the mid-levels, training them, and then beginning to utilize them for basic entry-level design sort of jobs. And these are fairly well-paying jobs. And that at some point in time is going to drive demand from this segment. And this is across not just the major cities, I mean, tier 1, tier 2, other cities as well. I mean, this is coming down, percolating down into those cities. So yes, I mean, as Madan mentioned, rationalizing the tax slabs, etc., in the mid to lower middle income earning segments is likely to give a little bit. I mean, but obviously, I mean, that's not a huge relief. I mean, a huge boost to the overall consumption power of this segment. It's going to help. But overall, I think this growth impulse is the most important, because if this growth happens and coming in, I mean, it's not just exporting manufacturing, it's exporting services, in the sense of getting many services-oriented segments into the country. And that is what is going to lead to the growth of purchasing power, consuming power, aggregate demand, etc., that all of us are talking about.
I think from an economics and a fiscal rectitude perspective, I would not be in favor of cutting income tax rates because one, the impact, as I think Saugata also said, you will have to make a meaningful dent on income tax rates to have any iota of impact on consumption. So because not that income tax rate do not matter, it's just that the number of people who pay income taxes in the country are far more lower. So if you have to make an impact on consumption, you would rather choose some other tool than tweaking income tax rate. So a better way would be to tweak GST. There is a case of GST rate not just being high, you also have a case of cess on certain items. And with now the sunset clause approaching, in fact, now already there, the government should now maybe have a relook, if not at the GST rates, at least at the cesses which have been imposed. So some of these cesses are pretty high. And if you take the effective rate of tax, then the GST rate, including cess, becomes pretty high. So if you want to make an impact on consumption, I think GST would do a far more better job than income tax as a tool. Now, is GST is a cut in GST rate or a GST cess advisable at this point in time? I would say probably not, because Sunny, we are coming out of a very difficult, challenging phase. And it's not that we are out of the woods yet. There is again dark clouds in the horizon in the form of adverse global environment, especially on the export side. So you would want to keep your powder dry as much as possible. You would want to leave as much as fiscal space that you can potentially generate. So in this kind of an environment, I guess the most important thing that the government can do with its limited set of resources is to first of all do a little bit of belt tightening, which essentially means that go for fiscal consolidation. And the next step would be to support this with the superior quality of adjustment. Now, you've already announced PLI schemes, you've already announced Gati, Shakti, etc. Now, is there something else? So PLI, for example, has been a success story in case of electronics. Most of us know that, but it has not, taken off for other sectors. Can the government do something else? Can the budget do something else to kind of replicate the success story that electronic sector has seen as far as PLI is concerned? So it does not involve a large amount of money. What it does involve is a little bit of policy focus, a little bit of policy design, and the budget can make a token allocation towards that front and focus all their energies on creating the right incentive structures for private participants to come on board. So it's more about the intent and how you want to do it than just putting money after money and ending up in a situation where you have to fund a large fiscal hole. So you have to tighten your belt as well as be smart about how you spend and what you spend.
But Sunny, out here, I would like to just point out that even though cutting income tax rates today may not really add to the big consumption story which we're talking of, but I think the government needs to definitely adjust all the income tax slabs with inflation. Because I think if you look at the individual households, I think they have been at major disadvantage. Inflation keeps going up, and every year we are being told this is not the right time for anything to begin, wait for another time. So this story has been going on for almost a decade. So I think there has to be an automatic mechanism saying that if inflation goes up by 5%, move up all the slabs by 5%. I think that will be some way at least of protecting the individuals rather than encouraging them to consume. That may not help to move the needle in terms of consumption, but it will provide a lot of protection in terms of real income.
But one last question, which I would want to pose and before we close, which is also connected to this whole debate of private capex, public capex, government spending, is the issue of jobs. I mean, Madan touched upon the layoffs in the startup sector and income levels not rising. There are also reports of unemployment rising. So how big do you see this issue of jobs being as pertinent for the budget that is coming, and whether it can be addressed?
I don't think that the budget is the appropriate platform. So obviously we are hearing about incentives, tax or other incentives for employment creation. We are hearing about allocating outlays to segments that are more employment intensive, say textiles, etc. So affordable housing, construction. But this is not a very budget-specific issue. I think larger structural issues are needed in terms of thinking out of the box in beginning to absorb some of the people that are displaced by technologies, etc. So using the healthcare segment, which is significantly understaffed in India. So we need to be able to devise appropriate skilling strategies, and maybe some budget allocations are needed for incentivizing private sector involvement in skilling. But a much larger set of initiatives are needed for this problem of providing quality jobs, not just low paying jobs, quality jobs. Much larger effort and thought is needed for this segment.
So I fully agree with what Saugata is saying. Budget is not the place which is going to create jobs. Two quick things. A, we need to commercialize agriculture. If we say 55-60% of our workforce is in agriculture, get back the farm laws. That's the only way in which you can commercialize them. Second, we are talking of manufacturing. I think manufacturing creates jobs. As long as manufacturing stagnates, which has been the case in the last 5-6 years, I think jobs won't be created. We're creating jobs with these Swiggy and Zomato people zipping around the cities on their two-wheelers, or construction workers. They're all low-paid jobs which don't really add to your to sustainability of family income.
Vivek, any closing comments on?
I think from my side so I would agree with both the panelists that budget probably is not the best of the platforms to talk about jobs, but nevertheless it can serve as a statement of intent. And from a job perspective, while you have traditional sectors like textiles, leather, etc., but you also need to see that from the agent perspective, or in fact, there are two major sectors. One you can say as construction, which is again labor intensive and job heavy, and the other one is MSME, which is again labor intensive and jobs heavy. So if the government can focus precisely on these two sectors, so construction, I agree, it's not entirely in the domain of central government. There is also equal amount of participation from the states on this matter. But as far as MSMEs are concerned, this is entirely the playground of the central government. And the kind of risks that we are staring at on the global side, it is probably time that the government focuses on them. It's not that the government has not been focusing on them in the last 2-3 years, especially in the Atmanirbhar Bharat scheme. But looking at the risks at the current juncture, and since the budget is going to be presented just about within a month's time, it will probably be pertinent to devise or tailor-made incentive structures for promoting MSME export, or at least preserving the kind of momentum that we've seen in the last 2 years, because stress is bound to develop in some of these sectors as we move forward in the coming quarter. So it's time that you start following up in terms of making announcements and start following it up in terms of policy actions.
Gentlemen, I think we have come to the close of the discussion. Thank you very much for a wide-ranging and very energizing discussion. Really appreciate you taking time for the ET Summit, and we hope we soon catch up and meet next time. Thank you.
Thanks a lot, Sunny.
Thank you so much, Sunny. Pleasure.